Licenses are rights to use companies' intellectual property, such as software, technology, and media. Some license transfer a right of use to intellectual property that has significant standalone functionality, meaning that it can perform a function or a task or be played or aired. The benefit the customer receives from the license isn't affected by the seller's ongoing activity. Examples of this functional intellectual property include software like Microsoft Office, drug formulas, and media content like books, music, and movies. For licenses of functional intellectual property, sellers typically recognize revenue at the point in time that the customer can start using the IP. Other licenses provide the customer with the right of access to the seller's IP with the understanding that the intellectual property does not have significant stand-alone functionality. Rather, the seller will undertake ongoing activities during the license period that benefit the customer. The seller might make changes to the IP over the course of the license, or could perform marketing or other activities that affect the value of the license to the customer. Examples of this symbolic intellectual property include trademarks, logos, brand names, and franchise rights. For licenses of symbolic IP, sellers recognize revenue over time because that is when they satisfy their performance obligations. Sometimes functional intellectual property also requires revenue recognition over time. This happens when the seller is expected to change the functionality over the license period and the customer is required to use the updated version. That's the case with some software products like virus protection. In that case, we view the license as transferring a right of access, so revenue must be recognized over the license period. Finally, sometimes a license isn't considered to be a separate performance obligation because it's not distinct from other goods or services provided in the same transaction. So an online service might grant a license to customers to access content at a website. In that case, the license isn't distinct from the website content because the purpose of the license is to access the content. As a result, the website access and license would be treated as a single performance obligation, and revenue would be recognized over time. So let's take a look at a concept question. Which of the following is not true? A. License fees are recognized over time for any license that is viewed as providing a right of access. B. Licensing fees are recognized as revenue over time for licenses of symbolic intellectual property for which the seller expects its ongoing activities to affect the benefits that the buyer receives from IP. C. License fees are recognized as revenue at a point in time for licenses of function IP for which the buyer expects that the seller's future activities will not affect the benefit the buyer derives from the intellectual property. And then D. Licensing fees always are recognized as revenue at the end of the period of the license, when the seller's completed its performance obligation to provide access to its IP. So as you know, the correct answer here is D. If the seller provides access to its intellectual property, then revenue gets recognized over the period of time for which the access is provided, and it's not deferred until the end of the license period. Here's another one. Zach developed software that helps farmers to plow their fields in a manner that prevents erosion and maximizes the effectiveness of irrigation. Spurlock paid a licensing fee of $60,000 for a copy of the software. Although Spurlock can use the software as long as he wants, Zach expects that Spurlock will use the software for approximately 5 years. Zach does not anticipate any further interaction with Spurlock following transfer of the license. So how much revenue should Zach recognize in the first year of the contract? Would it be 0, 12,000, 15,000, or 60,000? Well, the correct answer is D, because since Zach's transferring function intellectual property and it has significant standalone functionality. The license transfers a right of use, and then as a result, all license revenue can be recognized upon transfer of control of the software to the customer. Franchises are the next topic here we're going to talk about. So in a franchise agreement, the franchisor grants to the franchisee the right to sell the franchisor's products and use its name for a specified period of time. Franchises often include a license as well as goods and services transferred at the start of the franchise and over the life of the franchise. Each of these aspects must be evaluated to determine if they qualify as separate performance obligations and are accounted for accordingly. So which of the following is not true about accounting for revenue from franchise agreements? A. Franchise arrangements often include a performance obligation for a license as well as for delivery of goods and services. B. Franchise arrangements typically include one or more performance obligations for which revenue is recognized at a point in time. C. Franchise arrangements typically include one or more performance obligations for which revenue is recognized over a period in time. Or D. Franchise arrangements typically include one performance obligation because the goods and services included in the arrangement are not separately identifiable. So as you see here, the correct answer is D. Franchise arrangements typically include multiple performance obligations because the goods and services included in the arrangement are both capable of being distinct and are separately identifiable. So a bill and hold arrangement exists when a customer purchases goods but requests that the seller retain physical possession of the goods until a later date. For example, a customer might buy equipment and ask the seller to store the equipment until an installment site has been prepared. The physical possession indicator normally overshadows other control indicators in a bill and hold arrangement. So sellers usually conclude that control has not been transferred and revenue should not be recognized until actual delivery to the customer occurs. Consistent with SEC guidelines, sellers can recognize revenue prior to delivery only if they conclude that the customer controls the product and there is a good reason for the bill and hold arrangement, along with the product is specifically identified as belonging to the customer and is ready for shipment. So which of the following is true for a bill and hold arrangement? A. Revenue is recognized when goods are manufactured. B. Revenue is recognized when the arrangement is made. C. Revenue is recognized when the delivery of goods is made. Or D. Revenue is recognized at the point in time at which payment from the customer is received. So as you see here, bill and hold arrangements normally do not qualify for revenue recognition until delivery is made to the customer. Prior to that, control of goods usually is not viewed as having passed on to the customer. In consignment arrangements, the consignor physically transfers the goods to the other company, the consignee, but the consignor retains legal title. If a buyer is found, the consignee remits the selling price, less commission and approved expenses to the consignor. If the consignee can't find a buyer within agreed upon time, then the consignee returns the goods to the consignor. Given that the consignor retains the risks of ownership, it postpones revenue recognition until sale to a third party occurs. So Alex Guerin is an artist who sells his work under consignment. He displays his work in local barber shops and customers purchase their work there. Guerin recently transferred a painting on consignment to a local barber shop. After Guerin had transferred a painting to the barber shop, the painting, A, should be counted in the barber shop's inventory as a barber shop now possesses it. B, should be counted in Guerin's inventory until the barber shop sells it. C, we lack sufficient information to know who should carry the painting in inventory. Or D, should be counted in either Guerin's or the barber shop's inventory, depending on which incurred the cost of preparing the painting for display. So I hope you got this one. It's B. The consignment arrangements do not qualify for revenue recognition until deliveries made to the end user. Prior to that point, control of goods is viewed as having been retained by the consignor. So the consignor retains the goods in the consignor's inventory. Now, as we deal with gift cards, last, sales of gift cards are recognized as a deferred revenue liability, and then revenue is recognized when a gift card's redeemed or the likelihood of redemption is viewed as remote. NOAA sells gift cards redeemable for NOAA's products, either in-store or online. During 2018, NOAA sold $6 million of gift cards, and $5,400,000 of the gift cards were redeemed for products. As of December 31st of 2018, 450,000 of the remaining gift cards had passed the date at which NOAA concludes that the cards will never be redeemed. How much gift card revenue should NOAA recognize in 2018? The sale of gift cards creates a deferred revenue, as it's a prepayment by a customer for goods or services to be delivered at a future date. Revenue is recognized when the goods or services are delivered or when the likelihood of redemption is remote. So in this case, $5,400,000 were redeemed, and then another $450,000 were viewed as breakage, yielding total revenues of $5,850,000. Let's take a look now at exercise 515. Tech Morris sells franchise arrangements through the United States and Canada. Under a franchise agreement, Morris receives $1.2 million in exchange for satisfying the following separate performance obligations. Franchisees have a 5-year right to operate as a Tech Morris retail establishment and an exclusive sales territory. Franchisees receive initial training and certification as a computer mechanic, and franchisees receive a Tech Morris building and necessary equipment. The standalone selling price of the initial training and certification is $30,000 and $900,000 for the building and equipment. Morris estimates the standalone selling price of the 5-year right to operate as a Tech Morris establishment using the residual approach. So Morris received $150,000 on July 1st of year 1 from Connors and accepted a note receivable for the rest of the price of the franchise. Morris will construct and equip Connors' building and train and certify Connors by September 1st, and Connors' 5-year right to operate as Tech Morris establishment will begin on September 1st. What amount should Morris calculate as the standalone selling price of the 5-year right to operate as a Tech Morris retail establishment? Also, what journal entry are we going to record on July 1st to reflect the sale of the franchise? And how much revenue should Morris recognize in the year ended December 31st with respect to this franchise? So, what amount should Morris calculate as the standalone selling price? Well, the total franchise agreement is $1,200,000. We know the standalone selling price of training is $30,000, and the standalone selling price of the building and equipment is $900,000. So then the standalone selling price of that right for 5 years is $270,000. So the journal entry to record would be a cash for $150,000, a note receivable for the remaining, and we would credit deferred revenue for $1,200,000. Now, in regards to revenue recognized at the end of the year, what we would show is the training and certification of $900,000, the delivery of equipment of $30,000. I think that's opposite. The training and certifying should be $30,000. Delivery of equipped Tech Morris building should be $900,000. And then the 5-year right should be the $270,000 divided by 5 months out of 12 times 4 gives us $18,000. So the total revenue recognized for the year ended December 31st of year 1 should be $948,000. So apart from presenting the accounts and balances on financial statements, several important aspects of revenue recognition must also be disclosed in the notes to the financial statements. The disclosure notes or the income statement must include bad debt expense and any interest revenue or interest expense incurred. Notes also are required to explain significant changes in contract assets and contract liabilities that occurred during the period. Sellers must also provide detailed disclosures categorizing revenue in a way that would help investors understand the nature, amount, timing, and uncertainty of revenues and cash flows. Sellers also must describe their outstanding performance obligations, discuss how performance obligations typically are satisfied, and then to describe important contractual provisions like payment terms and policies for refunds, returns, and warranties. This slide provides a summary of the fundamental and special issues related to recognizing revenue. So to summarize these various steps, in step 1 we identify the contract. Now a contract establishes the legal right and obligations of the seller and the customer with respect to one or more performance obligations. And then there are some special issues if the contract has commercial substance or has been approved by both the seller and customer, or specifies the seller's and customer's rights and obligations, payment terms, and is probable the seller will collect the amount it is entitled to receive. Note, a contract does not exist if neither the seller nor the customer has performed any obligations under the contract and both the seller and the customer can terminate the contract without penalty. Step 2, we then identify the performance obligations. Now you can have performance obligations transferring goods and services that are distinct, which is the case if both the good and service is capable of being distinct and separately identifiable. But the following don't qualify as performance obligations: quality assurance warranties or customer prepayments, and extended warranties, customer options for additional goods and services that provide a material right. In these scenarios, these would then qualify as performance obligations. Next, as we move on, if I can make it move on. Step 3, we then estimate the various transaction prices. Now, the transaction price is the amount the seller is entitled to receive from the customer, and we would adjust the various prices for variable consideration, estimated as either the expected value or the most likely amount. Then whether the seller is acting as a principal or as an agent needs to be looked at. A significant financing component if you know that the receipt of the money is not going to happen for a time in the future, significant time in the future, and any payments by the seller to the customer. Then the fourth step is where we allocate the transaction price based on the various performance obligations based on relative standalone selling prices of the goods and services in each performance obligation. And then there's a couple approaches to this: adjusted market assessment approach, expected cost plus margin approach, or residual approach. Then we've got the summary of fundamental and special issues related to recognizing revenue. We can recognize revenue at a single point in time when control passes to the customer, which is more likely if the customer has an obligation to pay the seller, legal title passes, possession of the asset occurs, they've assumed the rewards and ownership, and the buyer has accepted the asset. Revenue recognition would happen over a period of time if the customer consumes work, a benefit as work performed, or the customer controls the asset as it is created, or the seller's creating an asset that has no alternative use and the seller has right to receive payment for work completed. Then along with all these, we've got special recognitions as it relates to licensing, franchises, bill and hold arrangements, consignment arrangements, and then finally gift cards. So let's look at a question. Which of the following is true about sellers' revenue disclosures? Sellers do not have to separate their revenue into categories that help investors understand the nature, amount, timing, and uncertainty of revenues and cash flows. Or B, sellers do not need to describe their outstanding performance obligations, discuss how performance obligations typically are satisfied, and describe important contractual provisions like payment terms and policies for refunds, returns, and warranties. Or C, sellers must disclose any significant judgments used to estimate transaction prices. And then D, sellers do not need to explain significant changes in contract assets and contract liabilities that occurred during the period. Well, which of these is true? It is C. Sellers must disclose any significant judgments used to estimate transaction prices or to allocate transaction prices to performance obligations and to determine when performance obligations have been satisfied. Now, long-term contracts are very complex, and they involve many products and services that could be viewed as separate performance obligations that take months or years to be completed. Step 2 and 5 are critical for these long-term contracts. Step 2 requires that sellers identify the performance obligations in the contract. A contract is viewed as including a single performance obligation if the goods and services in the contract are not separately identifiable. This is typically the case for long-term contracts, as the purpose of those contracts is to integrate goods and services into a single finished product. Step 5 is also important. Requires that sellers recognize revenue when performance obligations are satisfied. Long-term contracts often qualify for revenue recognition over time according to the percentage of completion, either because the customer controls the asset as it is completed or the seller is building an asset that is customized to the customer and the seller has a right to be paid for progress to date. If a contract doesn't qualify revenue recognition over time, revenue recognition is delayed until the contract is completed. Now, there are other complexities in this long-term contract understanding because the seller often retains title to the work in process at the time it's being paid by the customer. So we're going to talk about an example that deals with these various complexities. So to understand revenue recognition on these long-term contracts, let's walk through this slide. At the beginning of 2018, the Harding Construction Company received a contract to build an office building for $5 million. Harding will construct the building according to specifications provided by the buyer, and the project is estimated to take 3 years to complete. According to the contract, Harding will bill the buyer in installments over the construction period according to a prearranged schedule. Information related to the contract is shown here. So we see the various construction costs during the year, construction cost incurred in prior years, cumulative construction costs, estimated cost to complete at year end. So we've got our total estimated and actual construction costs, billings made during the year, and then cash collections during the year. So let's look at the accounting for cost of construction and accounts receivable for Harding for its long-term contract. These journal entries are not affected by the timing of revenue recognition. The first journal entry shows Harding's various costs during the construction process in an asset account called Construction in Process, or CIP. Think of CIP as work in process inventory. It contains the asset that Harding is building. The second journal entry records the periodic billings by crediting billings on construction contract at the same time that accounts receivable is debited. This account is a contra account to the CIP asset. Why create the billings account? A challenge with accounting for long-term contracts is that the physical asset, CIP, and the financial asset, accounts receivable, or after that, collection of the receivable, cash, are both on the balance sheet simultaneously, such that there's a double accounting for the same contract. By having billings as a contra to CIP, the net carrying value of the physical asset is reduced when the financial asset is recognized, so we avoid that problem. At the end of each period, the balances in the CIP and the billings are compared. If the net amount is a debit, it's reported in the balance sheet as a contra asset, a contract asset, because there's been more work done creating the asset than has been billed the client for it. Conversely, if the net amount's a credit, then it's reported as a contract liability, like a deferred revenue, because Harding has billed the client for more work than has actually been done to date. Harding also will report an accounts receivable for amounts it has billed the client and that's not yet been paid. Now let's see how revenue is recognized for Harding. We'll start with the general structure of the journal entry and then discuss timing. Let's start with recognizing revenue upon completion. Normally when we sell goods, we debit accounts receivable and we credit revenues, and debit cost of goods sold and credit inventory. Here we're crediting revenue and debiting cost of construction, like cost of goods sold. We don't debit accounts receivable because that happens when we bill the customer. We don't credit inventory because CIP is still on Harding's balance sheet. Instead, to make the journal entry balance, we debit CIP for gross profit. That has the effect of carrying CIP at its sales price, cost plus gross profit, which makes sense as we're acting like we sold it, but still have the asset on the balance sheet. Also, at the end of the contract, the CIP account contains total cost and gross profit, so it contains amount equal to total revenue. And the billings account contains all the amounts billed to the customer, which should equal the total revenues. So their balances exactly offset to create a net value of 0. Now compare revenue recognized upon completion with revenue recognized over the term of the contract. Note that the journal entries all have the same structure and that the same total amount of revenue, cost of construction, and gross profit is recognized, regardless of whether it is recognized over the term of the contract or upon contract completion. The only difference is timing. If a contract doesn't qualify for revenue recognition over time, revenue is recognized at the point in time that control transfers from the seller to the customer, which typically occurs when the contract has been completed. At that time, the seller views itself as selling the asset and recognizes revenue and expenses associated with the sale. Completion occurs in 2020 for our Harding example. Prior to then, CIP includes only cost, showing a cumulative balance of $1,500,000 and $2,500,000 at the end of 18 and 19 respectively, and totaling $4.1 million, which is the 1.5 plus the 1 million plus the 1.6 million, when the project is completed in 2020. Upon completion, Harding recognizes revenue of $5 million and cost of construction similar to cost of goods sold of $4.1 million. Because the asset is viewed as sold on that date, Harding includes the resulting $900,000 gross profit in CIP, increasing its balance to the $5 million total cost plus gross profit for the project. If a contract qualifies for revenue recognition over time, revenue is recognized over time as the project is completed. Each period, the revenue is to be recognized in that period is calculated by first calculating the total revenue that should be recognized to date, and then subtracting the amount of revenue recognized in the prior period. That approach automatically updates revenue for any changes in estimates that have occurred during the period. The tough part in determining progress to date. Typically, sellers estimate progress by measuring the proportion of effort expended thus far relative to the total effort expected to satisfy the performance obligation. These efforts could be cost incurred, labor hours expended, machine hours worked, or time lapsed. The most common approach to estimating progress towards completion is to use a cost-to-cost ratio that compares total cost incurred to date to the total estimated cost to complete the project. Let's assume the Harding project qualifies for revenue recognition over time and consider the calculation of revenue each year based on progress to date, estimated using the cost-to-cost ratio. Notice that this approach automatically includes changes in estimated costs to complete the job, and therefore an estimated percentage completion by first calculating the cumulative amount of revenue to be recognized to date and then subtracting revenue recognized in prior periods to determine revenue recognized in the current period. First, the cumulative amount of revenue to be recognized to date is calculated, and then revenue recognized in prior periods is subtracted to determine revenue recognized in the current period. We can see that each year the journal entry recognizing revenue over the contract period serves to update CIP to include that year's gross profit. At the end of the contract, CIP includes all costs and all gross profit, so it includes total revenue of $5 million, exactly equal to the $5 million billed to the customer. We end up in the same place regardless of whether revenue is recognized upon completion or over time. The only thing that differs is the timing. After the job is finished, the only task remaining is for Harding to officially transfer title to the finished asset to the customer. At that time, Harding will prepare a journal entry that removes the contract from its balance sheet by debiting billings and crediting CIP for $5 million, reducing the balance of those accounts to zero. We record the same journal entry to close out the billings and CIP accounts regardless of whether revenue is recognized over time or upon completion. Here we can see recognition of revenue, cost of construction, and gross profit in each period of the contract. In the balance sheet, the construction in progress account is offset against the billings on construction contract account, with CIP billings shown as a contract asset and billings CIP shown as a contract liability. When revenue is recognized over the term of the contract, CIP contains cost and gross profit. But if revenue is recognized upon contract completion, CIP typically contains only the costs. Therefore, CIP typically includes a larger amount if revenue is recognized over time. The exception is when there are overall losses in the contract, which are recognized in the first period the loss is anticipated, regardless of timing of revenue recognition. CIP in excess of billings is treated as a contract asset rather than an accounts receivable, because although Harding has incurred construction costs for which it will be paid by the buyer, those amounts are not yet billable according to the construction contract. Once Harding has made progress sufficient to bill the customer, it will debit accounts receivable and then credit billings, which will increase the accounts receivable asset and reduce CIP in excess of billings. So let's look at a concept question. Robertson Construction entered into a contract to construct a tunnel for a fixed price of $12 million. Robertson recognizes revenue over time according to the percentage of completion. Here are some facts. In 2018, we had $3 million of costs incurred, with an additional $6 million of additional costs to complete. In 2019, we had $500,000 of cost incurred, with an estimated cost of $6.5 million to complete. And then in 2020, we had costs incurred of $6,500,000. What is Robertson's percentage of completion in 2019? Well, the answer is 35%. We would take the $3 million plus the $0.5 million, divide that by the $3 million along with the $0.5 million and the $6.5 million to come up with our 35% amount of completion. Next, Robertson Construction enters into a contract to construct a tunnel for $12 million. Robertson recognized revenue over time according to the percentage of completion. We've got some different numbers here. In 2018, $3 million of costs were incurred with an additional $6 million to complete. In 19, $5 million of costs were incurred with an additional $2 million to complete. And then in 2020, we had $2.5 million in costs incurred. So what is Robertson's percentage completion in 2018? Well, the correct answer here would be 33.3%. The $3 million, divide that by the $3 million plus the $6 million, or this is 1/3 complete. Robertson Construction entered into a contract to construct a tunnel again for $12 million. So we've got costs incurred, $3 million in 18 with an additional cost of $6 million. In 2019, $5 million with an additional cost of $2 million. And then in 2020, $2.5 million. What is Robertson's percentage completion in 2019? 80% complete. We've got the $3 million plus the $5 million, and then from there we divide that by the $3 million plus the $5 million plus the $2 million of estimated additional cost to complete. Now let's look at another one. Robertson entered into a contract to construct a tunnel at $12 million, and then we see the various costs incurred along with the estimated additional cost to complete. The question is, how much revenue would Robertson recognize in 2018? So in 2018, we would recognize $4 million of revenue, which is basically the $3 million divided by the $9 million, or we've got 33% complete. If the full project is $12 million, then 33.33% would be $4 million that would be recognized in 2018. How much revenue would Robertson then recognize in 2019? So in this scenario, we would show $5,600,000. We would take the $8 million, the $3 million from 2018, the $5 million from 2019, which is $8 million. We'd divide that by the 3 plus the 5 plus the additional $2 million estimated to complete. If we have 80% complete, then we would take the 9.6 minus the 4 million to give us our 5.6 million to be recognized in 2019. Since it's 80% complete, 80% of the 12 million is the 9.6 subtracted from what we already have recognized. Then, in 2020, what would we recognize as revenue? Well, the entire amount has now been completed, so we would take the 12 million and we would subtract out what has already been recognized in order to determine then what needs to be recognized in 2020. Sometimes losses occur on long-term projects. A loss could either be a periodic loss that occurs for an overall profitable project or projected on the entire project. We have to consider periodic losses only if revenue is recognized over time, but we have to consider overall losses regardless of the timing of revenue recognition. When a project qualifies for revenue recognition over time, a loss sometimes must be recognized in at least one period along the way, even though the project as a whole is expected to be profitable. We determine the loss in precisely the same way we determine the profits in profitable years. So at the end of 2018, 40% of the project is complete. The $1.5 million divided by the $3,750,000. Revenue of $2 million, the cost of construction of $1.5 million gives us our gross profit of $500,000. That gets recognized in 2018 as we previously determined. But at the end of 2019, the company now forecasts a total profit of $400,000, the $5 million minus the $4.6 million on the project. And at that time, the project is estimated to be 60% complete, which is the $2,760,000. Divide that by $4,600,000 to give us our 60% complete. So as you see here, the revenue of $5 million times the 60% minus the $2 million equals $1 million. So we would have our cost of construction as a debit. We would then show our credit of revenues of long-term contracts, and then construction in progress as a credit for $260,000. No entry is made if revenue recognition is delayed until contract completion. If we're dealing with periodic losses on a contract that we expect to be profitable overall, because no revenue has been recognized to date. The point of recognizing periodic contract losses is to true up revenue recognized over time to the cumulative amount that should be recognized given current information. Now let's change the facts to reflect a loss on the entire project. Notice that in 2019 the estimated total cost of $5,100,000 exceeds total estimated revenue of $5 million. In 2020 there's more bad news with an additional $100,000 of costs before the project is completed. Let's start by considering how overall losses on a contract are recognized when revenue is recognized over time. Each year we calculate the revenue to be recognized in the normal fashion, multiplying total revenue to be recognized by the percentage of completion. In situations where a loss is expected on the entire project, we have to back out any gross profit recognized in prior periods and also recognize the overall loss. Then we can back into the cost of construction by adding the amount of the loss recognized to the amount of revenue recognized. For example, in 2019, Harding has to back out gross profit of $500,000 recognized in 2018, and then to add to that amount the $100,000 overall loss it thinks will occur on the contract. So the total gross loss to recognize in 2019 is $600,000. Revenue recognized of $706,000 is added to the gross loss of $600,000 to arrive at the cost of construction of $1,306,000. Recognizing revenue over time in this case produces a large overstatement of income in 2018 and then a large understatement in 2019 because of a change in the estimation of future costs. These estimate revisions happen occasionally when revenue is recognized over time. In 2020, the income statement will report revenue of $5 million and cost of construction of $5,100,000, combining for an additional loss of $100,000. The journal entries to record the losses in 2019 and 2020 are shown here. In 2019, the cost of construction of $1,306,000, the revenues from long-term contracts $706,000, and the construction in progress of $600,000. Then we've got in 2020 our cost of construction of $2,394,000, the revenue from the long-term contracts of $2,294,000, and our construction in progress $100,000. When the contract does not qualify for recognizing revenue over time, revenue recognition is delayed until project completion. However, it is an overall loss If that's anticipated, that loss must be recognized in the first period it's anticipated. So in our example, in 2018, nothing gets recognized because no overall loss is even anticipated. In 2019, loss on long-term contracts, which is an income statement account, is recognized for $100,000, and CIP is reduced by crediting it for $100,000. Then in 2020, the income statement will report the revenue of $5 million and the cost of construction of $5.1 million, combining for an additional loss of $100,000. Let's take a look at exercise 517. Assume KMP Networks contracted to provide a customer with internet infrastructure for $23,000. The project began in year 1 and it was completed in year 2. Data related to the contracts are summarized below. The cost incurred during the year 1, $2,900, year 2, $15,000. Then the estimated cost to complete as of December 31st in year 1 was $12,000, year 2, 0. Billings during the year, $3,900, year 2, $16,200. Cash collected during the year, $2,800 in year 1 and $17,500 in year 2. Compute the amount of revenue and gross profit or loss to be recognized in year 1 and year 2, assuming KMP recognizes revenue over time, according to the percentage of completion. And then in 2, we're going to compute the amount of revenue and gross profit or loss to be recognized in year 1 and year 2, assuming this project doesn't qualify for revenue recognition over time. Prepare a partial balance sheet to show how the information related to the contract would be presented at the end of year 1, assuming KMP recognizes revenue over time according to the percent of completion. And then number 4, prepare a partial balance sheet to show how the information related to this contract would be presented at the end of year 1, assuming this project does not qualify for revenue recognition over time. So let's start with the first requirement. We're going to compute the amount of revenue and gross profit to be recognized in years 1 and 2 according to the percent of completion. So the contract price is $23,000. Actual cost to date of $2,900 in year 1, $17,900 in year 2. If we estimate cost to complete in year 1 of $12,000 and in year 2, 0, we show our estimated cost for year 1 to be $14,900. In year 2, $17,900. So our gross profit in year 1 is $8,100. In year 2, it's $5,100. Now, the gross profit to be recognized over time would equal the contract price times the percent completed. As you see here, $2,900 of cost or actual cost to date divided by expected cost of $14,900. So in this case, we would take that percent, or 19.46%, times the sale price in order to compute the gross profit. In year 2, we would show revenue. This is how much we would show for revenue over time. In year 2, the revenue over time would be the $23,000 minus the revenue we showed in year 1 for the $18,523. So to compute the amount of revenue and gross profit or loss to be recognized, our gross profit then would be the revenue minus the costs, or $1,577 in gross profit, while in year 2, the $18,523 minus the $15,000 in costs to be $35,023. Now, if this project doesn't qualify for revenue recognition over time, in year 1 there would be 0. In year 2 there would be the entire amount minus our costs to complete, which would give us a gross profit of $5,100. We'll prepare a partial balance sheet to show this. We would show our accounts receivable, the $3,900 billings minus what was received would give us our accounts receivable in year 1 of $1,100, cost and profit in excess of our billings would show $577. The cost of $2,900 plus the profit of $1,577 gives us the $4,477. Now, the current assets would show our accounts receivable. We would show current liabilities of the billing in excess of our costs. Now for 5/18, on June 15th, year 1, Golden Crest Construction enters into a long-term construction contract to build an airport in D.C. for $440 million. The expected completion date is April 1st of year 3. Costs incurred and estimated costs to complete at year end for the life of the contract are shown in millions. So costs incurred during the year, $80 million, $160 and $100. The estimated cost to complete at the end of year 1, $240, year 2, $120, and year 3, $0. So we're going to take each one of these items, how much revenue and gross profit will Golden Crest report in years 1, 2, and 3, assuming Golden Crest recognizes revenue over time according to the percentage of completion. Then, how much revenue and gross profit will Golden Crest report in its year 1, 2, and 3 income statements related to this contract, assuming the project does not qualify for revenue recognition over time. And then number 3, suppose the estimated cost to complete at the end of year 2 are $160 million instead of the $120. Then determine the amount of revenue and gross profit or loss that would be recognized in year 2, assuming revenue gets recognized over time. So with number 1, the first thing we're going to do is compute the revenue and then ultimately the gross profit. So our contract price is $440. The cost to date for each of the years would be the $80, and then the $160 plus the $80 then gives us $240. And then in year 3 we have $340,000 of actual costs. As you see, the estimated costs to complete help us calculate at the end of year 1 what we anticipate the total estimated cost to be of $320. So our gross profit at the end of year 1, which we would think is $120, at the end of year 2, $80, then at the end of year 3 is $100. So in year 1, we would recognize revenue of the $80 million, divide that by our total estimated cost of $320 to figure out what percent we've completed. We take that 25% times the contract price of $440 million to come up with our revenue in year 1. In year 2, we do the same. Our $240 divided by our $360 gives us, we anticipate expect 66.67 of the contract is completed, times our $440 million price of the contract minus what we recognized in year 1, which would be $183.33 million. And then in year 3, we're going to do the same. Take what the revenue was in year 1 and 2, subtract it from the total contract price to give us the amount of revenue that would be recognized in year 3. So we've got our revenue that is recognized. How do we then calculate gross profit? Well, the cost actually incurred. In year 1, it's $30 million, the 110 minus the 80. In year 2, it's the 183 minus the 160. And then in year 3, it's the 146.67 minus the 100 million, I should say, in costs of 46.67. So now we are looking at the revenues and gross profits and looking at the income statements related to the contract, assuming Golden Crest recognizes revenues over time. So we can use the percentage of completion method showing $30 million. In year 2, we're going to show $53.33 million. And in year 3, $23.33 million. And then in year 3, we will take the difference, $46.67 million would be our gross profit. Then we have to show what kind of revenue and gross profit is reported if this contract doesn't qualify for revenue recognition over time. Year 1, we would show zeros, 2 zeros, and then in year 3 we would show the entire amount and the total gross profit. Now it's telling us in year 2, instead of the $120 million, what if the estimated costs are $160? So we would take the $240, divide that by the $400, which is our new revised estimated costs, and we would show 60% has been completed, times the contract price, shows our revenue recognition of $264 million to date, minus what was recognized in year 1 to give us the revenue for year 2. The 154 in revenue minus the costs that were incurred will give us a gross loss in year 2. So basically we've got, by changing the estimated costs, we would have an estimated in year 2 loss of $6 million. The entire calculation of profit of the $240 million in year 2 divided by the $400 is 60%, times $40 million. So basically what we're doing here is showing the breakdown of the revenue recognition. Now let's look at exercise 521. Automia Construction contracted to build an apartment complex for a price of $10 million. Construction began in year 1 and was completed in year 3. The following are 2 different situations involving different costs for the project. So, in situation 1, cost incurred during the year, $3,000 for $0.2 thousand, and $1.8 thousand, with estimated costs to complete the project at the end of year 1, $6,000 and $1,800 for year 2. Then we have situation 2, as you can see, cost incurred and then estimated cost to complete it. Determine the gross profit or loss recognized for the 2 situations when gross profit's recognized over time and it's when gross profit's recognized upon completion. So in situation 1, our contract price is $10 million. Actual costs to date for year 1 are $3 million, $7,200,000, and $9 million. Estimated costs to complete are given to us. So our total estimated costs in year 1 are $9 million, in year 2 are also $9 million, along with year 3. So the estimated gross profit shows $1 million in year 1, $1 million in year 2, and $1 million in year 3. Now, determine the gross profit or loss on these situations with situation 1, gross profit recognized over time. So we're going to take the contract price times the percent completed minus the actual cost to date. So basically in year 1, we'll take our revenue which will be computed by the actual cost to date divided by our total estimated cost of 33.33% times the contract sales price to give us the revenue recognized in year 1. Our gross profit is then going to be the revenue minus the costs, or $333,000. So we can also figure the $3 million divided by the $9,000 equals the 33.33% times 1,000. So now moving on, in year 2 we recognize the gross profit by the total cost divided by our estimated cost total gives us 80% completion times our contract sales price, gives us the revenue that should be recognized, take away what was recognized in year 1 to give us what needs to be recognized in year 2. We calculate our gross profit by taking the revenue recognized in year 2 minus the actual cost that were recognized in year 2. So if total costs, actual costs to date in year 2 is 7.2 and actual costs in year 1 were 3, we know the difference were costs incurred in year 2 to give us then our gross profit. Next, this is when gross profit's recognized over time. So in year 3, we would recognize $10 million minus 3 for year 3,333 for year 1, 4666 revenue recognized in year 2, which means the difference gets recognized in year 3. Our gross profit then is going to be the amounts 1,000 minus the 333 minus the 466 leaves us with 200. Now determine the gross profit recognized for the 2 situations when gross profit's recognized over time and when gross profit's recognized on completion. So for on completion, 0 and 1, 0 and 2, and the full amount in year 3. Now, when in situation 2, these are new figures. Again, our contract price stays the same, but our cost incurred and estimated cost are different. So our actual costs to date are shown, then our estimated costs to complete are in there, giving us our total estimated costs to help us determine in year 1, year 2, and year 3. In year 1, we'd have a $200,000 gross loss. In year 2, it would be $400,000. And then in year 3, we've got $600,000. The loss of year 1, loss of year 2 would be the full amount of loss subtracted by what we already showed in losses for year 1, gives us a remaining $200,000 loss recognized in year 2. And then also in year 3, we would take every loss that was recognized in years 1 and 2 to give us the remaining amount for year 3. Total gross profit or loss recognized. Year 1, $200,000 loss. Same with year 2 and year 3. So, next we are going to look at exercise 522, where Amber Construction began construction for a 3-year contract. The contract price is $1,610,000. Long uses the percent of completion method. The financial statement presentation is shown as follows. We need to determine the cost of construction that actually occurred in year 1, how much cash was collected in year 1 on the contract, what's the estimated cost to complete as of the end of year 1, and the estimated percent of completion used to calculate the revenue in year 1. So we've got shown on the balance sheet accounts receivable of 30, construction in progress 100, billings on construction 93,000, cost of uncompleted contract in excess of billing 7,000, then our income before tax on the contract of 24,000. So we're going to take what costs were actually incurred. We know the construction in progress ended on the balance sheet with 100,000. We showed a profit of 24, which gets included in our CIP. And so as a result, if we ended it with 100, showed a profit of 24, we know our cost had to be 76,000. So, on this one, how much cash was collected? Well, if we have a receivable of 30, our billings were 93, then the difference, 63,000, is what was actually collected in cash. Then, the estimated cost to complete at the end of year 1. So if we show that, we've got our $1,610,000 would be the sales price. We've the construction to date of 100,000, which shows our profit of 1,610,000 divided by the 100,000, the 24,000 profit, which helps us to see what our construction in progress was during the year, and our beginning costs to date 76,000, but throughout the contract completion we anticipate our costs, including our profit, to be 1,610,000. So the 1,223,600 minus the 76,000 in cost to date gives us a remaining $1,147,600 in costs to still happen. What's the estimated percent of completion used to calculate revenue in year 1? Construction in progress of 100 minus our contract price gives us what was completed of the 6.21%. Boy, is there a lot to cover in this chapter. I wish you the best. Review, study, and go over it again and again.